Welcome to India CSR. In this edition of India CSR YouTube Story, we will be exploring the regulatory framework for environmental, social and governance (ESG) investments in India. The framework was issued by the International Financial Services Centres Authority (IFSCA) on 18 January 2023, with the aim of establishing GIFT IFSC, International Financial Services Centres, as a hub for sustainable finance activities. The International Financial Services Centres Authority framework for disclosures by fund management entities is an important step in promoting consistency, comparability, and reliability in ESG investment disclosures. The framework is aligned with international best practices and is expected to drive sustainable finance in India and contribute to the growth of the ESG investment market. As the demand for sustainable investments continues to grow, the regulatory expectations set by authority will help fund management entities design and manage ESG schemes in a transparent and responsible manner, thereby encouraging more investors to invest in such schemes. The framework is applicable to retail schemes, exchange-traded fund, ETF, restricted schemes and venture capital schemes. It incorporates terms such as environment, social, ESG, green or sustainability in their names or represent themselves as ESG-focused schemes. For every ESG scheme launched by a fund management entity, FME, the FME is required to disclose information such as the name of the scheme, investment objective, investment strategy, risks and risk management practices, benchmark and periodic disclosures. The name of the scheme should be reflective of its ESG focus, and the investment objective should transparently disclose the nature and extent of the scheme's ESG-related goals. Fund management entities must also disclose their investment process, including the methodology for ESG-related processes such as initial investments, monitoring, engagement, and exits. Additionally, fund management entities should disclose all the specific risks that arise from the pursuit of ESG-related investment objectives and strategies, and may designate a reference benchmark for the ESG scheme to measure its ESG focus and financial performance. Periodic disclosures must be provided to the authority and investors twice a year for retail schemes and once a year for other schemes, including information on compliance with ESG goals, performance, and the proportion of investments being used as stated in the strategy. If there are any deviations from the strategy, the company must also report that. In conclusion, the framework issued by Authority for ESG Investments is an important step in promoting sustainable finance and driving economic growth in India. The regulatory expectations set by International Financial Services Centres Authority, IFSCA, will help fund management entities in designing and managing ESG schemes in a responsible and transparent manner. Thereby, it will be attracting more investors to invest in such schemes. Thank you for tuning into our discussion on the ESG framework. We hope you enjoyed this story. If so, please consider giving the video a thumbs up, sharing it with your network, and subscribing to our channel for future updates on CSR, sustainability and ESG initiatives and developments. Your support is greatly appreciated. Thank you again for being with us.